Hello and welcome to Ticker Tapes. Today, we're back in the world of ETFs. Just when you think you've seen the top of the energy markets, they confound you and move higher once more. Only one out of the top 30 performing ETFs over the last week is not energy related, and the average return over the last 5 days for the top 29 ETFs that are is 8.69%. What's more, 33 energy related ETFs are now up by more than 50% year to date. Funds that track natural gas remain in the driving seat. For example, UNL, the U.S. 12-month natural gas ETF, is up by 142.14% so far in 2022. ETF investors have also been able to achieve decent returns and diversification within the energy sector this year. RYE, the Invesco S&P 500 Equal Weight Energy ETF, has gained over 70% year to date. The fund tracks an index of energy companies spread across the industry as a whole, and no one holding has a significantly higher weighting within the fund than any other. Though, of course, if you are invested in RYE, you get diversification within the energy sector, but not within the market as a whole. Traders can get equal weighted exposure to the broader equity market via ETFs such as RSP, which tracks the S&P 500 Equal Weight Index. Over the last 6 months, RSP has outperformed SPY, the cap-weighted S&P 500 tracker, though both ETFs are down over the period, RSP by just 6% and SPY by 11.45%. The weighting and underperformance of the large-cap technology stocks within SPY is one of the main reasons for its underperformance. The S&P 500 Information Technology Index is down by 18.28% over the last 6 months. Turning to fund flows, that underperformance hasn't deterred investors from putting money into cap-weighted blue-chip equity funds. The iShares Core S&P 500 ETF, IVV, saw $2.23 billion of new money come into the fund last week, whilst rival VOO, the Vanguard S&P 500 ETF, picked up $1.29 billion of inflows. It looks as though investors may have been switching out of SPY because it saw $3.45 billion of outflows last week. One of the attractions of putting money into passive ETFs is the low fees that the funds charge. However, there is competition within the industry, and IVV and VOO have a far lower expense ratio than SPY, so a swap could have been made on the grounds of costs. Over the longer term, a lower expense ratio could mean outperformance for investors in one fund over another. So what we may be witnessing here is a money manager changing horses for their clients mid-race, so to speak. We also saw a big bet on further downside in the NASDAQ 100 index, with $908 million flowing into SQQQ, the ProShares Ultra Pro Short QQQ ETF. This is a 3 times leveraged inverse ETF, which means it's designed to rise in value as and when the NASDAQ 100 index falls, and to do so at 3 times the rate of the index change. However, this is a purely directional play, and if the value of the NASDAQ index rises instead, then the price of SQQQ declines 3 times as fast.